All right, guys, welcome to Accounting for Decision Making. To start with, we are going to differentiate between managerial accounting and financial accounting. Accounting for decision making is also called managerial accounting. That is accounting information that we provide to management for purposes of making decisions, managerial accounting. It is based on an internal perspective, internal focus, management focused, versus this one is based on external. We give it to investors, creditors, banks, financial accounting, right? The information that we get from that. But this one is based on employees, management, making decisions internally, right? Another thing is that there's no rules for preparing managerial accounting statements, but here we have GAAP, Generally Accepted Accounting Principles. What I mean by that is the FASB statements that are in the accounting standard codification. All the financial accounting rules are in a document online. You can go to fasb.org, fasb.org. If you go there, on the top left, there is something that we call accounting standard codification. And that contains all the accounting principles and rules that we are supposed to use when we prepare financial accounting statements, balance sheet, income statement, statement of cash flows, and the notes, right? So GAAP stands for Generally Accepted Accounting Principles. These are statements that have substantial authoritative support in the profession, and they are enacted by the FASB in the US and the IASB internationally, okay? So in the US, we follow accounting standard codification when we do accounting. Internationally, they follow IFRS, International Financial Reporting Standards. But that is financial accounting. When we talk about managerial accounting, there's no rules, okay? Now, these are interested in money from investors. Money from investors. They want investors to put money in the company. But here, we are focused on decision making. We want to make decisions about pricing. We want to make decisions about product. We want to make decisions about our sourcing. We want to make break-even analysis decisions. We want to make a make or buy decision. We have a lot of internal decisions that we have to make, okay? As a result of that, here we are going to pay attention to the raw materials, also called the direct materials, the labor, and overhead. And we are going to make sure we pay attention to each of these. But here, the concern is on finished goods. Finished goods inventory. This suggesting that this one is mostly applied to manufacturing companies. Manufacturing. It doesn't mean that it doesn't apply to service companies, but the managerial accounting for decision making, especially the elementary chapters, will be dealing with manufacturing companies. But this one will also be dealing with both manufacturing and service companies. Does that make sense? However, going forward after the elementary chapters, we will start applying the concepts that we learned here in managerial accounting also to service companies. So now this is just a brief comparison of managerial accounting versus financial accounting. There could be other points that you can make to differentiate them. But I want us to dive into what we call direct materials. Let's say we are making a shirt, the one that I'm wearing right now. We want to know the direct materials, the raw materials that are used to make this shirt. Will be cotton, right? Cotton. We use cotton, right? They have buttons, they have colors, they dye, some pieces of it is blue, some are white and stuff like that, right? So we call it direct materials. Let's say the direct material cost per unit for one shirt per unit is $100. So that's what we call direct materials. Does that make sense? And you need to then pay attention to direct labor. Direct labor is people that directly work on cutting the cotton, making sure it's in good shape for it to be able to be sewn into a shed that I could wear. And the direct labor costs money. So let's say that they spend 10 hours and we pay them $20 an hour. So that will be 10 hours times 20 gives me 200. Does that make sense? This plus that is going to be 300. We're going to give it a nice fancy name that you should remember. We're going to call it direct costs. And another name for it is prime cost. So if I give you information and I ask you to calculate the prime cost, all I'm asking you is add the direct labor and the direct materials numbers together. Does that make sense? So I'm intentionally going to ask you to calculate the prime cost. You're going to ask me, what is prime cost? And I'm saying prime cost means direct materials plus direct labor. Does that make sense? Okay. Now the third piece is what we call overhead, or manufacturing overhead, if you like. Overhead, like what? Building depreciation, supervisors, if you like, supervisors' salaries, lights and utilities in the place where they are making the shed. That's overhead. So let's say that the overhead came to 50. So you add that to that, and you're gonna get what? 350. So this is my total cost. This is my total cost. Does that make sense? Right. So, but the overhead plus the direct labor, we can give it a nice fancy name and call it conversion cost. So if I ask you to calculate the conversion cost, you are going to say direct labor plus manufacturing overhead, which is $250. $250. Does that make sense? So I'm introducing you to the terminologies that we are going to be using in this class. First terminology to remember is materials, labor, and overhead. Material plus labor, direct costs, also called prime cost. Manufacturing overhead, when you add it to that, it's going to give you a total cost. But then the overhead itself plus the direct labor, this plus that, we're going to give it a fancy new name and call it conversion cost. Does that make sense? So this is just terminology. Now I'm going to be pounding, increasing it. Okay? Make sure you remember this plus that is that, and this plus this one is conversion. Make sense? All right, now let's go on to something that we call, so let's say that if we were going to price this product, will you sell it for more than $350, $250, if this is how much it costs you to produce it? You will try to, right? Because you want to recover your costs. But if you go to the market and the market is pricing it at $300, what are you going to do? If you don't sell it for $300, you're going to lose out. Nobody's going to buy your product. It's too expensive. So now you're going to have to go and ask your competitors, how did you, something that I'm making for $350, you made it for $300, less than $300. Does that make sense? That's what the Japanese did to Americans. They make cars using target costing. Target costing means instead of starting from the top, direct materials, direct labor, direct that, adding it together and then adding a profit margin, they don't do that. They go to the market and say, how much will you pay for this car if I made it? They say, I'll only give you $30,000 for a price price. Say, fine. I'm only going to gather materials and labor and stuff that will cost me less than $30,000. And when I finish, I'll add my profit and then I can come and sell it to you for $30,000 because that's what you want. Does that make sense? So they reverse the process. They reverse the process. Because if you do it this way, you are trying to give them the best of materials, the best of labor, the best of expenses to make sure the car is nice and cute, but they're saying they won't be able to afford it. So instead you ask them, how much will you be able to afford? And then you build it backwards. We call that target costing. Does that make sense? Now, I'm introducing another terminology. Contribution margin. Contribution margin. That's something that you should know, okay? Contribution margin sales minus variable cost. So if my sales is $500 and my variable cost is $300, what is my contribution margin? 200. 500 minus 300 is what? 200. That's what we call contribution margin. Now let's talk about the concept of margin and markup. Okay? Margin and markup. People get confused on that concept, but I want to make sure that on day one, you understand the concept of margin and markup and how to manipulate your way. Margin, markup. Margin means percent of sales. Markup means percent of cost of goods sold, or percent of cost, if you like. So in this example that I was given here, my total cost was $250. If I want to charge 10% markup, $10 of $350 is what? $35, right? I'm not gonna do this for free, right? My cost is $350. I want 10% profit, so I'm gonna add that markup to it, and then that will give me 583, and that is probably the price that I'm looking at, my starting price. Right. Now, so whenever I have a percentage and I express it as a percent of cost of goods sold, I'm going to use the word markup. That is why this is a markup, because I took a percent of a cost number. Does that make sense? Okay. So let's say that my markup is 10%. 10 divided by 100 times 350 gave me my markup of 35. Now, the question that I'm asking you is, what is the margin? It is always going to be the same percent number divided by 100 plus or minus that number. What I am not sure instantly is whether I should add it or I should subtract it. But I do know that since you are taking a percent of cost, which is a lower number, your markup is going to be lower than your margin, or margin is going to be higher than the markup. So in this case, I am going to say, let's do 10 divided by 90. And what is 10 divided by 90 times 100? Somebody tell me. So I subtracted instead of added. What is 10 divided by 90 times 100? Do it. Do it on your phone. Do it on your calculator. Go ahead. 11 points. 11.11. So when you have a margin, and if you take 11.11% of this number, you are going to get 35. But I'm going to do another example to make it easy, okay? Because it can be a little hard because of the numbers that I'm using. Now let me use another number to make it easy for you. So let's say that my margin as a percent of sales is 20% of sales. And so if my sales is $100, 20% of 100 will give me what? $20. Be 20 divided by 100 times $100, and that gives me $20. So if my margin percent is 20%, what is my markup percentage? I know it's going to be 20 divided by 100 plus or minus 20. Okay? Now I have to think. Which is bigger, margin or markup? Which will be bigger? Sales? Margin is going to be bigger. So then the markup is going to be what? 20 divided by 120 times 100. And what is 20 divided by 120 times 100? Do it on your calculator.
16.67.
16.67. But if you did it the other way and you said 20 divided by 80 times 100, what would that be? 25%? Yes? Okay. So what you are trying to figure out is, if I give you margin of 20%, and then I intentionally give you cost of goods sold of $80, you will not be able to calculate this $20. This is where the trick comes in, okay? Because I told you margin is a percent of sales, right? That assumes that every time I give you margin, I'll give you sales. But here's what I'm going to do to you on exams. I'll give you a margin of 20%, and I'll intentionally give you cost of goods sold of $80, and I'll ask you to calculate the profit. You cannot multiply these two numbers. Why? Because this is a percent of sales, and this is cost of goods sold. So it's either you are going to figure out how to convert it to sales, or you're going to figure out how to convert this to markup. Does that make sense? Because now I'm tricking you. Under exam condition, most people will say, well, the answer is 16, and that's wrong. Why is it wrong? Because I gave you two different identities. If I give you a margin, you need to find sales. Or you have to convert the margin into a markup and then do the multiplication. So in this case, you would say, okay, you gave me margin of 20%. I need to convert that into a markup, 20 divided by 100 plus or minus 20. Right. And then here, if you're saying that margin is bigger than markup, then margin was going to be 20 divided by, if I do 120, it's going to be 60%, right? But if I do 80, it's going to be what? 25%. And if I multiply this 25% by 80, what do I get? What's 25 times 80? A quarter of 80 is 20. And if you add it, the 80 to that, you get 100. It is the same thing as taking 20% of 100, you get the same number. Does that make sense? So what we have learned is that the markup percentage is going to be a higher percentage than the margin percentage. Now, if you know that, you'll be able to figure it out. That, well, should I subtract or should I add in the denominator? Does that make sense? So that's one of the tricks that we do. I think you've gotten enough on managerial accounting. Now I'm going to ask you to buy a calculator that will help you in this class. And then once you buy the calculator, we'll be back into action.